Welcome to Wealth Beyond the White Coat, a show where we dive deep into the world of financial freedom for dentists and medical professionals. I'm your host, Darren Flesher, a dentist with a passion for uncovering the strategies that lead to a prosperous life beyond the office. Every episode will explore the avenues of alternative investing, tax mitigation, and secrets to build wealth that the textbooks don't teach you. Whether you're looking to enhance your financial literacy, discover new investment opportunities, or simply find a better way to manage your money, this is the place where your financial health is the core of our conversations. Welcome to Wealth Beyond the White Coat, where your journey to financial clarity and freedom begins. All right, welcome back. In today's episode, we'll dive into an expert Q&A session where we tackle some of the most pressing financial questions facing dentists and medical professionals. We'll explore strategies for diversification, tax mitigation, and making the most of alternative investments. So whether you're looking to optimize your current portfolio or just starting your financial journey, this episode is packed with valuable insights.
And obviously, questions are great. And if you can submit your questions ahead of time, that's even better. But so first question I'm gonna ask Matt is, how should we be diversified across alternative assets? Like how much oil and gas should we have? How much multifamily development should we have? How much venture capital should we have? So across the alternative universe, and how much non-alternative should we have? So across the financial sphere, how would you describe an ideal diversification, Matt?
Give me 1 second. So I want to, and Chris had brought up some before, so I think a good process for people might be, like I'm sure everybody in this group every week, some financial something comes up in their head. I would just say, hey, anytime during the week, if we're going to do these on a weekly or bi-weekly basis or whatever, bi-monthly, however that works, just anytime you have a financial question that pops in your head, write it down and send it in. And then we'll just aggregate those and put them together and start to open those in an open forum. Because typically when one person has a question, multiple people have the question, and that'll let us answer it and create some content around it. I think things that are timely might be
even if it's just a text to me, text me or Darren, and we'll have it in our thread and we'll know, and we can organize it. Just the easiest, lowest barrier to entry to get the question to us.
Yeah, just any question you have that comes up that's finance related in any way, don't hesitate to just put it in here. Consider us your financial concierge. We'll answer those questions in an open forum and get everybody on the same page and just say, here's what you should know about that. Some of this is noise and some of this is fact. Right? Like you guys tell us all the time, you're supposed to floss every day. Nobody flosses every day. And guess what? My teeth ain't falling out. So I think you guys are pulling a fast one on us. But anyway, I digress.
Conspiracy.
It's a conspiracy. You guys all get shares of the floss company stock when you come out of dental school. And that's why you push it so hard. That's my belief system on that one.
So Ross is basically referring to financial buckets. How much of our net worth is our active businesses? How much in alts, plus how do we diversify amongst that? How much in maybe a traditional kind of stock market buy and hold strategy? And maybe we have a cash bucket or an emergency fund. And then tax mitigation bucket, right? What am I missing? And obviously I'll let you guys run with this because I'm not the expert.
Sure. Look, most of the guys that are in this space are going to be high earners, high achievers because of the way their business is working. And most of them's largest asset will be an illiquid, non-traded asset, non-volatile asset. It'll be their practice, right? That's the biggest asset that almost all of these guys will own outside of their primary residence, which anybody that's been on a conversation with us, when you're looking at somebody's investment ability, we don't measure the equity in somebody's home as an available asset. So it doesn't really count towards net worth from an accreditation standpoint. Your overall net worth, but it's not an asset you can redeploy. It's more like just a forced savings account. And in the state of Florida where I live, there's unlimited homestead and creditor protection. That's why a lot of people own really expensive primary houses in Florida and don't live in them, because if anything went bad and you lost a whole bunch of money or you got sued, they can never take your house in the state of Florida, and you fire sell your $10 million house for $8 million and then you're back in the game, right? Downsize. So look, if their business is their primary asset, the problem for most people that we're solving today is for income tax mitigation. And from an income tax mitigation, the goal should be primarily to look at the break point between the 24 and the 32% tax bracket. For a married filing jointly, that happens around 350 at the federal level. For a single individual, that happens around 175. And try to eliminate those dollars above that break point from a tax mitigation standpoint, if that's what you're looking to do. Now, the problem with that is some people have a lifestyle that exceeds that. For example, if you're married and have a lifestyle of $30,000 a month that you need to spend to pay your bills, that's $360,000 a year, which means you need to earn 20 or 25% more than that, pay taxes on 25% more than 360, which is basically what 360 plus 784 is. So about really about 460, I guess, is what somebody would have to earn to pay taxes to net 360. So we couldn't completely make those people tax efficient because their lifestyle dictates that they need $30,000 a month in spendable income. But what we find is most people live on somewhere between $15,000 and $25,000 a month spendable, which means they can earn 350, pay taxes on that, and have enough to match their lifestyle needs. So from that perspective, all the income dollars above that could fundamentally be tax planned out. So let's assume, hypothetically speaking, we were going to use oil and gas as a solution. Today, currently, we have 4 oil and gas sponsors in market. They're fully due diligenced. We have a sponsor level opinion, deal level opinion, tax level opinion. Oil and gas works on federal taxes and state taxes in every state. It is in the code. It is not going anywhere. So if somebody's trying to tax plan and they're looking to use oil and gas, then there's 4 programs in market right now. Now, the way, unfortunately, I think most people have been trained to look at alternative investments is in a binary landscape. And that is not the correct way to look at it. And what I mean by binary is somebody looks at 4 oil and gas deals and they go, oh, I like this one better than this one. And I like A better than B. And then I like A better than C. But, oh, I like D better than A. So I'm going to put all my money in D. Well, that's not the right approach, in my opinion, and I understand why people do it. It's because some oil and gas programs are in different basins. Some of them are by more sponsors that might seem legitimate or credible. Some have projected higher cash flow. Some of them have a projected higher intangible drilling credit associated with them. So people try to compare those things and pick the one that they like the best. But the real answer is, at the end of the day, no one has ever said that diversification is a bad thing. And if a client comes in and says, hey, I need oil and gas and I want to do 400,000 of it, if we've got 4 deals in market, there's a real argument to be made for diversifying that with a $100,000 unit across all 4 oil and gas deals, because then you have sponsor diversification, strategy diversification, geographic diversification, probably commodity risk diversification, because some of them are going to be oil and gas, like oil, West Texas Intermediate. Some of them are going to be liquid natural gas. And so the other one will be wet gas and dry gas. So you could diversify. Now, many people don't, because there's some of them have an early investor discount, which is certainly something we should take into account, because there are economic advantage to getting in an early investor discount. But remember, diversification is still a good thing, even though one of those assets might have an early investor discount that you're a big fan of. So we just need to be cognizant that if we can diversify, that concentration will make you rich if you pick the right product, the right strategy at the right time, but diversification will keep you rich. So by having 4 completely vetted deals that all solve the tax problem in a same or similar way, you're splitting hairs by trying to pick one deal over the other. And so I would recommend that I think diversification is a good thing and should be considered on a case-by-case basis if we're solving that income tax problem. Questions?
Hey, I just want to interrupt real quick and say thanks for listening to the podcast. If you didn't know, we have an associated Facebook group also called Wealth Beyond the White Coat. Over there, you can ask your questions, get feedback from group members, and have a close community of medical professionals who are likely interested in the same things as you. Whether it's alternative investing, tax mitigation, ways to keep more of your money, or even protect your assets, we're going to discuss those things in the group. Additionally, we have a private investors club called Legacy Point. As a member, you'll get exclusive discounts to preferred vendors, and you'll get access to private investments that you'll find nowhere else. Whether it's hotels, apartments, oil and gas, equipment rental, you name it, we'll be discussing those details and offering those investments to members only inside Legacy Point Group. If you want to learn more about that, please contact me, or simply email info info@legacypointgroup.com, or go to the website legacypointgroup.com. And Wealth Beyond the White Coat podcast listeners get an exclusive discount if you use the code WealthBeyond. That's all caps, all together, WealthBeyond at checkout. I'd love to have you in the group, and I'd love to see you making more passive income as you move towards financial freedom, whether it's freedom to retire early, spend more time with your family, go on more vacations, or just do more of what you love while you're in the operatory. I'd love to see you doing that as part of Legacy Point. So here's to improving your financial health.
When solving a tax problem, diversification, let me say it this way. Are you saying when solving for a tax problem, diversification across different asset classes isn't really is a small thing to consider because it's only certain asset classes that have tax benefits? Is that what you're saying?
You're only considering the universe of programs that are oil and gas working interest drilling programs with intangible drilling credits, or IDCs. It's not like we're looking at the whole universe of tax programs that are out there. We're looking at the ones that might fit your facts and circumstances. If oil and gas is what makes sense, then you should consider all the oil and gas programs if that's the tax mitigation tool that fits for you. If it's an animal breeding program, if we have more than one in market, you should consider all of them. If animal breeding fits your fact and circumstances better than oil and gas does, then, and we only have one, then maybe you can't diversify outside of oil and animal breeding, but you could add oil and gas and animal breeding and get a same or similar net economic benefit to it. So you can still diversify.
For everyone who's laughing, animal breeding is a real sponsor. It is a real program, does have real tax benefits. Matt and I have been to the auction, to the farm, seen it all. We can talk to you about it another day, but it's closed for the year anyway. But go ahead, Chris.
To piggyback on your question, and I know where you're headed with this, Matt, let's say I believe in the oil and gas. I like the investment, but I've been using it to mitigate taxes for a few years, and I'm starting to wonder, am I getting over concentrated in this? And I think that's partly what Ross was saying. What's the argument? Because you have to spend money to save money in this situation, and you're largely in the oil and gas sector.
So look, that discussion is really about oil and gas, because if every single year you invest money to save your taxes, you might be with some of the same or similar sponsors because they typically open annual vintage programs. Like a good sponsor might have a 2019, a 2020, a 2021, a 2022, a 2023, but those are all different wells and different acreage. So if you invest in their 2021 fund and then their 2022 fund, yes, it might be the same sponsor, but the cost basis in those assets, the cost of the mineral rights that are being sold in the secondary market, and the fund vintage are completely different. So like in the history of me doing this, like I have sponsors that their 2021 program kicked ass and their 2022 program was okay. It didn't suck, but it was just not as good as the 2021 program. So you get diversification within years of vintages. If you think about it like wine, you could have a vineyard that you love buying wine from, but depending upon the seasonality and the climate in a particular year, the humidity, the grapes and the rain and all the other stuff, you might have one wine from the same vineyard, same exact wine, taste a little different. A 2019 might taste a little different than a 2021. Doesn't mean either one of them are terrible and it's swill and you're going to throw it out, but they might have little nuances into the taste, the way it hits your palate because of what the seasonal factors were in the vineyards in that particular year. The same would be true and applicable as it applies to oil and gas. It doesn't mean it's not going to work. It means that it just is going to ultimately work a little differently because they're drilling holes in different acreage.
So let's assume that I have an unlimited capital account that I can just do whatever I want with. And I've mitigated all my taxes. I've bought all the oil and gas I need or whatever to mitigate my taxes. There's obviously multiple sectors in the alternative investment space. So if I have already done my tax planning and I'm sitting on a very large cash account that I want to deploy, how would you diversify across other asset classes, non-tax related?
Financial freedom is about making the right moves at the right time. As practice owners, we often reach a point where growth stalls. Instead of maintaining at that plateau, consider cashing in now, putting that money to work for you, letting it double, triple, or even more over the course of your career, and then go pursue more of what you love to do. This is exactly what I did with my friend JW, a dental practice broker who found the perfect partner for my practice. maximized its value, and optimized the deal terms. He offers a free valuation for those considering a sale. If you want an introduction and the same red carpet treatment shown to me by my friend JW, email me at darren@legacypointgroup.com. That's DEREN at legacypointgroup.com. And I'll be happy to connect you with JW to start your journey to financial independence.
Congratulations, first of all, for being a good saver. Way for you to accumulate a whole bunch of cash. Nice job, pal. At least you didn't go out there and buy yourself a boat, a plane, and a helicopter and all that stuff.
So I might be a unicorn in this scenario, but let's go with it.
There you go. There you go. So the savings unicorn that we're talking to right now. So look, there's some fundamental tenets when it comes to financial planning, whether you're talking about liquids or illiquids. And one of those being what we call the prudent man rule. And you can Google this. This is all very Googleable stuff. But as a general rule of thumb, a 5% concentration in any one particular asset is enough. And so what I mean by that is a 5% concentration of your overall investable net worth. So if you're worth $10 million of investable assets, a 5% concentration of $10 million will be a $500,000 slug. So if you were going to make an alternative investment election into something, I would probably say that you keep that allocation at 5% or under if you're capable of doing that. Sometimes there's tax reasons that you have to go over the prudent man rule, but tax reasons are typically an annual vintage solution. So there is some annual segmentation of the diversification. So I would say a 5% rule. And that's one of the issues that a lot of people make as a mistake is they once again look at these alternative investments in a binary fashion. Oh, I like this one better than this one, and I have 400,000 to deploy. I want to put it all into that one deal. That's why right now, as we're legging into this, we're going, look, learn the process, learn how we do it. If you've got $400,000 to deploy, let's put $100,000 in 4 different programs that'll all work a little bit differently. And most people have heard this. In liquid investments, you have growth investments and you have income investments. Alternative investments are not any different. You've got growth investments in the alternative world. You've got income investments, and you've got a combination of the two, some that have income along the way and a big kicker on the back end. So it really depends on where you are in your financial life. If you're not taking any stress off of your portfolio from an income perspective, then maybe allocating to more growth assets with more upside is a good solution to you. If you like to see the income come in every single month and hit your checking account, ringing the cha-ching paychecks coming in that I didn't earn, then maybe allocating to some income investments along the way so that you can have some that are growing. And growth investments typically grow much faster than an income investment will kick off income. When the private credit markets, which is where income stuff comes from, we're typically looking at yields or distributions between 6 and 14, maybe 6 and 15 on the yield or the income perspective. But then in the growth sector, you're looking at things growing from probably, mid-teens to, look, if we're looking at MOIC deals, there's 100% IRR opportunities out there, but those should be limited to maybe a 5% concentration of your portfolio, each individual opportunity. And I know that we've talked with some MOIC, multiple on invested capital, MOIC. I know we've talked about that a couple of times. If we reference something in a MOIC, it means the IRR is most likely higher than 100% because it can't be calculated by IRR anymore. So it's multiple on invested capital. So it typically shows up, I put $1 in and I get $3.5 back, and that might take 2 to 5 years to do. But such a high IRR, it's easier to describe it in multiple of invested capital. It's $1 into 250, $1 into 325.
Matt, one thing that you, Chris, and I have all seen is there is a good opportunity that comes, and people want to basically back up the truck and put their entire liquid net worth in that.
Mm-hmm.
I want you to speak to that, but I was talking to someone the other day about an opportunity, and I'm getting FOMO. I said, please do not get FOMO. There are new deals that come to market on a weekly, if not monthly, if not weekly basis, and they're all great deals. If you sit this one out, there's another great deal that's coming. So speak to don't back up the truck, because it's not the greatest thing since sliced bread. It's not the deal of a lifetime. And the fact that there is basically almost an unlimited inventory of great deals out there.
Okay, that'll do it for part 1. Before I give my little recap and clue you into what's coming in part 2, I wanted to give a heartfelt thanks for all the listenership. I'm really enjoying creating all this podcast content and have really enjoyed getting all the feedback, both directly through email and also in the Facebook group. I've been really surprised at how many people are downloading and listening, and especially where they're listening, to be honest. We have listeners in 9 countries, including not only the US, but France, Switzerland, Italy, Russia, Australia, Spain, India, and Panama. So if you're really enjoying this, I hope you continue to share it with your friends and colleagues, and they get as much out of it as you do. Again, I really appreciate all you guys, and please continue to share, comment, like, and leave reviews. Please also continue to engage in the Facebook group. And as a reminder, today we discussed the importance of diversification across different asset classes, including oil and gas, multifamily, and more. Our experts shared their thoughts on balancing active business investments with alternative investments to create a robust financial strategy. Stay tuned for part 2, where we'll get into specific strategies for mitigating taxes and maximizing returns in today's volatile market. Thanks for listening in to Wealth Beyond the White Coat. Your time and attention mean a lot to us. If you found value in today's episode, please consider leaving us a review on your favorite podcast platform and share it with your colleagues and friends. Your feedback helps us grow and reach more professionals like you striving for financial freedom. Until next time, keep pushing the boundaries of your financial health. Thank you for joining us on this journey to wealth beyond the white coat.